Schultz. Now, Peter has been showing self-directed investors how to trade successfully since 1996 and is nationally known speaker on options trading. He is the founder of Cash Flow Heaven with the primary goal of helping individual investors achieve better lifestyle through trading strategies proven to produce exceptional monthly returns. That is his focus. And in today's presentation, he's going to talk about selling credit spreads in volatile market conditions. He's going to talk about why selling credit spreads is a smart, high odds strategy. He's going to share 3 strategy rules that he uses for consistently leveraging time decay. And he's also going to share when to close your position to protect your profits. So with that, I'm delighted to introduce Peter Schultz and to welcome him to the room. Peter, the floor is now yours.
Thank you, Raleigh. I appreciate that. Can you hear me? Just give me a nod if you can.
Yes, we can hear you loud and clear, buddy.
Okay, fantastic. And how do I grab the screen?
Okay, I think if you
share screen.
Yes, share
the big green button. Would that have something to do with it?
It does. It's either that or you're entering a large position in the market. I'm not sure which one.
Exactly. All righty.
And we do see your screen, selling credit spreads. Yeah, you might want to put that in presentation mode and we'll be ready to go.
I got it. So listen, I'm gonna get launched here, get going. Raleigh, thank you for the introduction. And this is how to sell credit spreads in high volatility markets. And this is 3 keys to turning scary markets into dependable money machines. And if you're familiar with credit spreads, you know how well they work. But you're going to learn some incredible things today about how to make them work better. Website cashflowheaven.com has a lot of good information on it. We publish a lot of good strategies, but the winningsecret.com is the strategy that we're going to talk about today. And it's been enormously effective. And if you've ever dreamed about making your living trading, this is probably the best strategy you could possibly use for one simple reason. It's incredibly dependable and it's very easy to defend, even in volatile markets. So speaking of volatility, most people will tell you selling credit spreads in volatile markets is crazy and it's not possible and that you shouldn't do it because credit spreads are typically thought of as a low volatility strategy. And it is possible, and you're going to see how to make consistent money with them in this presentation. So the key is stacking the probabilities overwhelmingly in your favor. And there's 3 big deck stackers you'll need to win consistently and generously. And I'm going to show those to you right now. So the first one is sell where the stock is not likely to go. Now this seems really obvious, but it's not as hard as you might think. Just identify the trend for the time frame that you're in. Sell put spreads if the market is trending higher. Sell call spreads if the market is trending lower. And it's amazing, even within a lot of volatility, you can still win consistently using this very first simple rule. Now, let me show you how that works on an actual chart. So this is, and everything that I show you is going to be actual trades that we've done about in the last 3 weeks. So none of this is going to be hypothetical. If you take a look at a chart of the S&P 500 over the last 4 months or so, you're going to see some incredible volatility. As you can see in March, the thing just absolutely dropped like a rock, and then it rebounded in the same fashion. And if you look at some of these bars here, you can see bars that are 30, 40, 50-point moves, even to the upside. So there's a ton of volatility here. And just to bring you up to speed on a put spread or just credit spreads in general, if you don't know about them, I'm going to grab my little pen here. And here's the strategy just in a nutshell. If you're familiar with them, this will take a minute, just a quick second. If you're not, this is pretty darn cool. This is amazing. So as you can see, the trend on the SPX is higher. Okay, you can just tell that at a glance. Now you're going to have some trend breaks in here. It did it right here. There's huge volatility here. But what we're doing is we're selling in the opposite direction of the trend. So the idea is for the stock or the index to move away from us, and whatever we sold becomes worth a lot less. And at expiration, all that money just takes up permanent residence in our account and we keep it. And you could do several of these a week, and they're just expirations coming around constantly. One of the cool things about time is you don't have to do anything to make it go by fairly quickly. So what we do is we'll sell, in this case, a put spread. These are puts, and the market is going up, so we're selling put spreads. If the market was going down, we would sell call spreads. So you sell this option right here, this put, and you take in a certain amount of money. To hedge yourself, to limit your risk, you will buy the option right below it, and you take in a smaller amount of money. The difference between these two is a credit. And that credit, like I say, it can be pretty decent and pretty consistent. And once you have it, you get to keep it. The key is how the trade turns out. So the game that we're playing here is we want to sell something that the underlying never touches. So it's kind of like a game of tag. So you never want the underlying to break through and touch our sold strike. Now, if you look at this, chances are it won't. And the probabilities just automatically, when you do this strategy, are so in your favor. You're automatically, even if you do a Rip Van Winkle and take a nap right after you put on this trade, you're probably going to win the majority of the time. And you can tell that by the math. So the math that created the modern options market is Nobel Prize winning math. So the three mathematicians that came up with that formula, the Black-Scholes model, did that in 1973. It made the modern options market possible. They didn't get the Nobel Prize for it until 1998. It took a little while. But it's incredible math. And the math tells us that based on the options that we're selling, we're going to win just automatically, all other things being equal, 80% of the time. And that's how things work out if you just put on the trade and forget about it. If you do a few things, and what I'm going to show you here, you can actually increase your odds from there, which is why this is such a consistent way to make money and kind of a worry-free, kind of a hands-free way to make money. So in this particular case, this is an actual trade. We were expecting that the SPX would kind of revert back a little bit to its trend line, which it did. And we collected a pretty decent credit. And what I really want you to look at, I mean, this was a profitable trade. It expired out of the money. Our options expired out of the money. But what I really want you to look at is your probability of winning here. You would have to see a major reversal in the SPX in order for you to lose money on this trade. Yes, that does happen, but most of the time the market either trends or goes sideways. So here's another spread we did just recently. You can see the time frames on these. This was just about a week and a half ago. This is on NVIDIA. They're a really advanced chip maker. They're growing really fast. They're doing really well. So we saw this uptrend here. These are fairly easy to spot. One of the things I like about this strategy is you don't need super complex technical analysis. If you just can identify an overall trend and a couple of simple patterns, you can make a lot of money doing this. So what I like to do is once again, this is a put spread. The stock was kind of trading sideways after rebounding and had just a throw over here on the trend, immediately reversed back above it. That's a bullish sign. And then it traded sideways. And often when I see these horizontal sideways moves off of consistent support, it's kind of like building a launching pad. And that's usually what happens with the stock. So when, and it usually launches in the direction of the overall trend, the direction that's been going. So when you see right here that it's kind of had a lid on it, and then it breaks above that, that's a pretty positive sign. And that's a good indication that this stock is going to head higher. And so we sold our spread, but all of this volatility here, the volatility that you see right here, creates some pretty big premium. So in this case, this was just a 3-day trade and we collected 57 cents. And that's actually a pretty good return. So here's what happened. I want to show you the rest of the chart right up until expiration. So as you can see, it actually did launch. It continued to go higher, kind of followed its trend line up, and our spread expired worthless. And that was a 30% profit in just 3 days. And, a pretty sure profit. I mean, these things aren't fluky. I mean, you can repeat this over and over and over and turn your money fairly quickly. And I'll also show you some really great ways to limit your risk on these. which really takes the fear out of trading them in volatile markets. So one of the things that people assume about selling spreads like this is selling short-term options is that you're really taking advantage of time decay. And that's the one thing about options that you can really rely on. Time decay never sleeps. The biggest difference between options and stocks is that options have an expiration point. You know when they're going to be done, you know when they're going to be over with. So here's a really good example of how a time decay curve works. So we're out here at between 4 months and 3 months right here. And you can see that this curve is, kind of shallow. You're losing a bit of time value, but not too much. And then from 3 months to 2 months, you'll see where it kind of steepens up a little bit. And then where it starts to steepen up a little bit more here is when you're just transitioning from being over a month out to being actually the front month. And you'll start to see it steepen. But where the really, really steep part of the time decay curve happens is right here, right before expiration. And it actually, what's interesting about time decay, and this curve is such a revelation for a lot of people because time decay does not decay in a straight line. It actually accelerates the closer that you get to expiration. So in this last month, it starts off just steeper than it has been, but it really accelerates down. And so towards those last couple of weeks, the time decay, the value of this option is almost going straight down. So we've determined that the perfect amount of time to sell, and this is after a lot of back testing, is from about 2 weeks to 1 week out. So this is about 2 weeks. This is about a week. And what we typically do, and you can write this down, you can take some notes if you want to, is we sell about 10 days at a time. That's really typical. And the reason we do that is it's enough time to collect a pretty generous premium, but it's also so little time that actually every single day of time decay puts money in your pocket. And so what options traders typically do that sell these options is they're kind of counting off the days until expiration. They're kind of looking at it, they're, a little bit more of that time value is going in their account every single day, and they just can't hardly wait to get to that finish line. So a good question, if you're doing this, if you're selling time value, a good question is how can we, it's right over here, how can we accelerate that time decay? So if you'd sold 10 days at a time, how could you magically make it feel like maybe 5 or 6 days at a time? How could you actually speed up getting to the finish line where you get to keep all that money, you get all your margin back, and you're ready to make your next trade? So that brings us to deck stacker number 2, and that is sell high volatility options to capture inflated premium that is likely to dissipate quickly. So remember, we make money by selling time that devalues as the option approaches expiration. But this strategy accelerates time decay with volatility collapse, making you money in some cases, and this is crazy, even if the underlying goes against you. So one of the really, really cool things about selling credit spreads is a stock can do only one of 5 things. And the 5 things is it can go up dramatically, it can go up a little bit, it can go sideways, it can go down a little bit, or it can go down dramatically. And the only way you can lose is if, and this is, even the trend's on your side, but let's say it reverses trend and it goes down dramatically. That's the only way you're going to stop out of a position and lose money. So already that's hugely in your favor. So the whole key here is to get to that finish line as quick as you can. Well, that happens when volatility really inflates the price of an option. And that hardly ever lasts. It doesn't last too long. And very quickly, that volatility goes out. It's like a balloon deflating. And that time, every day of time was worth a certain amount, and now it's worth less. So say if you were to sell 10 days at a time, and each day, and that was worth $1. You took in $1 on a position, which is maybe $1,000 if you did 10 contracts. Well, every day is worth 10 cents. And that is if the volatility is really high. But what if after a day or two, the stock or the options settled down and that time was only worth 5 cents just because of the volatility collapse? it's like somebody cut the time in half till expiration. And it's one of the biggest secrets, and almost nobody takes advantage of it. But you're gonna see in this presentation how you can easily take advantage of it and put the already overwhelming odds of selling credit spreads even way more in your favor. So here's the question everybody asks. Don't volatility markets create huge risk in selling spreads? Well, yes, they do. But if you know how options are priced, you can take advantage of that volatility premium to make even bigger profits with actually less risk. So here's why. When you sell a credit spread, you're selling options that are entirely time value. That's all we're selling because it's out of the money. So there's no intrinsic value because the option is completely out of the money. So the key is how the market assigns value to the time portion of the option. That value has a lot to do with expectations, and expectations have a lot to do with what happened with the underlying in the recent past. So for example, if a stock or index just made a big move or just reported earnings or just whipsawed in both directions, exactly the kind of thing that happens in volatile markets, the implied volatility goes through the roof. And I'm showing you just a little chart off to the side. This is on Home Depot. Look at the crazy moves in that stock. I mean, it's just moving all over the place. And let's actually take a look at a bigger chart of it. So here it is. This is another actual trade we did. So look at, speaking of volatility, look at this volatility right here. So the stock just went straight up and then it went straight back down again. And I mean, this is like a, you know, a pretty decent move in actually just one day. This is the 28th to the 29th. And this had to do with their earnings. Their earnings came out, stock popped way up. But you know what happened is after it came back down, it continued along the same trend that it had been on. So right about here, when the stock started to go up, we decided, you know what? This is a really good place to sell a spread. So we actually took the spread in here. This turned out to be just about 3 days a time by the time we got filled. We started to see it go up, so we got filled right here in this time frame. And the stock went up, it dipped back down again, and then it popped higher. So we were able to collect 45 cents or 22% for just 3 days of time. And what happened is as soon as it started heading higher, as soon as it gapped up here, that volatility collapse just took out the last remaining value. And then we hit expiration. So normally you can't sell 3 days of time and collect this much premium, 22%, but we could do it because of the volatility spike. And one of the things about volatility is it can be impressive, but it usually doesn't last very long. And a really good example of that is if you've ever looked at the volatility index or the VIX. Now this is for the S&P 500, but what you'll see if you look at the VIX is you'll see the occasional spike in volatility. A lot of people call this the fear index. And what's interesting is these spikes of volatility usually denotate something scary happening in the market. You know, the market starts to crash or really goes down a lot in one day and you see a spike. But here's what's cool is it never lasts very long. So this is a 60-minute chart. If you can see, we've got our dates down here at the bottom. This entire spike just lasted from the 11th to, you know, it's pretty low down here on the 16th. So, and there was a couple of days of weekend in there. So this is only just 1, 2, 3, 3 days, maybe 4 days for this entire spike to play itself out. So volatility doesn't last too long. Now, low volatility can last a really long time. We've seen where markets have just, you know, gradually trended higher for months and months and months, and there is very little premium available when that happens. So in many ways, high volatility markets are a better time to sell credit spreads than low volatility markets. So these jumps, these big spikes in volatility create a lot of opportunity. And often that value stays with the option, even as the stock starts to come down, which is why one of the best times to sell an option spread is the day after a stock announces earnings, because the options premium is still really elevated, and yet the stock is already settling down. That's a little trick. So after an event happens, and there's all this craziness, and you have a day or so to figure out which way the stock is going to go or how this is going to react, it's a great time to sell a spread, collect a lot of premium, and then that volatility collapse just puts money in your pocket. So one of the easiest ways to see this behavior where you'll have a big spike in volatility and then it calms down is with Bollinger Bands. So if you've ever looked at Bollinger Bands, you know that when they get narrow, like right here in the center of the chart, when they get narrow, that's usually a sign you're going to see a big move one way or the other. When you see that move, and in this case, it really spiked lower. It went down for a couple of days, and then we saw a big gap down, and then, you know, it bottoms out right here. As soon as you see that start to turn higher, as soon as you see that day or two of upswing, this is a fantastic time to sell a put spread and really take in some premium. And what'll happen is yeah, we saw a big spike down, but look at all this sideways action. You know, all of a sudden it's contained in a fairly narrow band here for a few days. Then we get a big spike higher. We see that the Bollinger Bands narrowing once again. We get a big spike higher and then it stabilizes, goes sideways. This is a great time to sell a call spread because you get really big premium and there's a really good chance that it's going to reverse, or at least the volatility is going to go out of those options and you're going to get to keep that premium. So once again here, we had a little bit of a narrowing of the bands, and then sure enough, the thing falls out of bed. Great chance to sell put premium. So just to summarize, when those bands are wide is when the time value of the options are an extreme high. That's when we want to sell call spreads or sell put spreads. It's often the perfect time to sell. As you can see from the chart, explosive moves don't last. They're almost always followed by periods of calm. And when the stock starts to settle down into a sideways move, all that volatility premium dissipates. So wouldn't it be nice to see at a glance whether options premiums are expensive or cheap? You know, when you get an idea that you want to sell a put spread or sell a call spread, you can take a look and you can kind of see what you can get, but how do you know if they're expensive or cheap? Well, fortunately, there is a way. Many options trading programs and brokers now show statistics for historic versus implied volatility. Historic volatility is what the range of movement has been over a longer period of time, and implied volatility is what the volatility is right now. So the key to selling options is to take advantage of inflated pricing. So you sell when the implied volatility is higher than the historic volatility. That tells us at a glance that the time value of the option is high, and then it's a good chance of selling lower in the immediate future. So where do we find this information? You know, we want to be able to tell before we make the trade. You know, that's the really cool thing about options is they're all based on a formula. So you can get a lot of information like your probability of winning before you even make the trade. And if you're selling overpriced options and that there's a good chance that underlying, that stock is going to settle down, well, that's putting just a huge advantage in your favor along with time decay and along with selling where the stock isn't going to go. So we generally recommend the Thinkorswim platform for options because they have really great trading tools, have the ability to get you filled inside the spread, and are competitive on their fees. Any good options trading platform should be able to provide this information, but on the Thinkorswim platform, you go to the trade tab and enter whatever underline you're interested in, either a stock or an index. And at that point, all the different expiration dates will populate under your ticker. So that's the options chain. Well, you scroll to the bottom of all the dates, the options chain, and you'll see a drop-down arrow that says today's option statistics. Click that drop-down arrow and you'll see all kinds of options numbers, but what you're looking for is the current historic volatility percentage versus the implied volatility. So I've got a little circles around here to make it easier, but I'll just circle them again. So in this case, you're looking, and that current historic volatility is 19%. And the implied volatility is 30%. Now this 11% difference is about as high as you'll see. You know, sometimes it gets more than that, but that's like a typical spread. So when you see that, and you see that the implied volatility is higher than the current HV percentile, then the option is expensive. And, you know, you're going to get a lot of money for selling that thing, and chances are good those two numbers are going to come back together again. And that volatility collapse puts money in your pocket just instantly. It's super, super cool. And it's this big edge a lot of options traders don't know about. So, I mean, this is just huge. Now, if the implied volatility is a lot lower than the historic volatility, some people use that to buy a debit spread. So doing the opposite of a credit spread, they buy a debit spread. The problem I have with that is, you know, markets can stay complacent for a long time. And if something's moving sideways, it still needs to move through your debit spread to make you money. What I love about credit spreads is the stock, it can go sideways, it can dribble along, it can go in your favor, it can even go a little bit against you and you'll still win. You know, the odds are so stacked in your favor and you really don't have to watch your trades very closely. I'll show you how to enter some automatic orders if you decide to come on board, and it's great. It's a strategy you can just really, it's a great lifestyle strategy because you can pretty much walk away. But what you want to do is this is one of those strategies where you kind of make all your money when you first set it up. You set this thing up the right way. It's very hard to lose and very easy to win. So here's what's interesting about the time value of an option. Everyone thinks the value is based on the time remaining until expiration, but how is that time priced? You know, that's really elastic. So the time value is really based on the implied volatility of the underlying. So what we want to do, essentially, what we are when we sell these credit spreads is we're really time merchants. We're selling time. So what we want to do is sell expensive time. And that's time with a lot of volatility premium attached to it. And we want to buy back or close cheap time. And this is probably the best trick. This is the best way to do that I have ever seen. And it works like a charm. So here's what's interesting about the time value of an option. And we just talked about, it's really based on volatility. So here's a really great example. So this is another one that we just actually did. This was Walmart came out with their earnings in May. And the stock absolutely exploded to the upside. So it was already on an uptrend. They came out with earnings and the stock shot higher, as you can see. And then, as often happens, everybody takes their profits and they sell, and this creates this big reversal. Or maybe on the earnings call, they heard something that they didn't like. And so the stock not only reversed those days' gains, but it also went way back down lower than where it started, you know, quite a bit of time earlier. This is actually a 60-minute chart. These aren't daily bars. I kind of blew it up so you can see this better. And then the stock trades lower. So down here, look at this 120 area. So if you sold a spread, let's say you sold a 120, 118 spread, okay? And this is an example to show you how powerful this concept is. This is going to blow your mind. If you're an options trader, you know the first thing that you start off with, and the absolute most important, is to get the direction of the stock right. You know, you don't want to be overrun. You don't want the stock to go in a direction that's going to hurt your position. So if you sold the 120 puts and you bought the 118 puts to hedge, and you collected a nice credit on this, what you want is for the stock to go higher or sideways at the very worst. But the last thing you want is for that stock to go towards your position. That's when it gets kind of scary. But that's exactly what happened here. Is the stock shot higher. All this volatility premium was created when this did that, especially when it reversed. So the put premiums just went through the roof. And if you sold this spread, you would have collected a huge amount of money. But all of a sudden, all your victory starts to turn to worry because you see the stock reverse and start heading towards your position. So let's see what happened. And we just talked about it. It's reversed. That's what we talked about on the last screen. It's reversed and it's heading towards your position. Now, this is normally where you'd be wanting to take evasive action here. So this is what actually happens. So one of the really cool things about the Thinkorswim platform is you can enter an actual option in the platform and you can chart it just like you would a stock. So here's the value of that. So you see this big spike right here when the stock shot up and reversed. This is this big spike in value when it reversed, and this option got up to 90 cents. Now, if you trade options, you know 90 cents can be quite a bit when you multiply it. You know, that can be $900 with 10 contracts, whatever. It can be a substantial amount of money. Now, the whole rest of the time, and this is the point of all of this, the whole rest of the time, the stock went toward your sold strike. But look what happened to the value. At one little point here, it dipped below this trend line, and we saw a little bit of a spike. but not nearly as much as the value up here. You know, the most it spiked to is maybe 60 cents. And yet look how much closer you are to the underlying. You got down there to about, you know, $1.21, just $1 away from your sold strike, as opposed to being $11 away from it or $10 away from it up here. But here's what happened. All the value of that option, even though it's going towards your sold strike, so even though it's going towards the direction of the puts, it completely evaporated. So the value of the 120 put shot higher to 90 cents after earnings. Then the stock traded down toward the 120 put strike for the next 2 weeks, yet the option still declined in price. So this is one of the best examples of volatility collapse that I could possibly show you. I think it's amazing because what it shows us is that a combination of time decay and volatility collapse actually trumped the direction of the stock. That's how powerful it is. So in this case, and this is what your takeaway from this, which I think is astounding, is if you would have put on this put spread, you were completely wrong about the direction of the stock, and you still made maximum profits on the trade. This is how forgiving this is. This is why I love this. Every other trading strategy that you're ever going to see, and there's going to be a lot of them presented in this live event, you have to be pretty much right on the money. Your entries have to be right. Your exits have to be right. You have to be really good. So these three deck stackers put the odds in your favor so hugely, so greatly, that you can actually be really wrong on direction and really screw up the trade and still make money. I think that's great. And if you're looking for an edge, this is it. So here's actually showing what happened. What's amazing is the option declined in price in spite of trading toward the strike, mostly because of volatility collapse and also time decay, which in this case, and this is what we mentioned, trumps direction. So we went from, in just, you know, you can see just a few trading days here, we went from a value of 90 cents down to a value of nothing. All that value, all that money ends up in your account for you to keep. So this brings us to our next key, and it's what makes this next key possible. This selling high volatility and buying back when the volatility is low, it really accelerates time decay. So it makes Deck Stacker 3 possible, and that is make your money and get out as soon as possible to limit your risk. Volatility collapse lets you do that because it accelerates time decay. So in volatile markets particularly, now if it's a trending market and it's real complacent, a lot of the time we'll let them go to expiration. But in volatile markets in particular, it's smart to learn how to take the money and run. But if you close your spread early before expiration, how much money are you leaving on the table? Now that's a good question. So here's a really good example. So this is a trade we just did recently. You can see this was done in June, the beginning of June. Visa's been, and this is my actual commentary. This is actually what you'll see when you subscribe. So Visa's been steadily rising and now looks ready to climb into the late February gap from 200 to 209, providing some nice distance from our sold strike. So once again, you have this support here, this horizontal support. You have uptrending support. I like to sell below 2 levels of support at least. So we've got this horizontal support, and once again, that's kind of like a launching pad. So, but because, you know, there'd been a little spike in volatility up and down here, we got a really good premium for selling this spread. So this was selling the 190, 187.50, and we sold that spread for 45. Now, a little bit of time had gone by. We hadn't gotten all the way to expiration yet, but you know, it was up here. We had done really well. I was kind of looking at the overall market thinking, you know, there might be a reversal. So I sent out an update and I said, listen, we've realized just about all of our profit on this trade, that the option is only worth 5 cents. That's it. So we brought in 45 cents. We could buy it back for 5 cents. So I said, let's just buy it back. And that's what we did. So we kept, so 5 cents represents just 10% of our total. So we ended up keeping 90% of the profit, and we got a 20%, you know, very easy, very consistent return. So you can see this is up about, this is above 200. It's got a really nice trend. It's going up, but we decided to buy it back anyway, just to be safe. And we are in kind of volatile markets right now, so it's a good idea. So let's see what happened next. Holy mackerel. So the day after we bought it back, the stock gaps lower and goes all the way down below 190, it would have stopped us out of this position at a loss, and we didn't have to worry about it because we'd already collected 90% of our profit. Why stick around for that last little nickel? Why take that risk? And you can see why you shouldn't. There's these 3 days here of just really, a really big spike lower. Now, Visa popped higher, it rebounded, but that wouldn't have helped you if you would have been stopped out already. So sometimes it's really a good idea to take your profits. And this is a recent actual real life example that's right from the subscription. So you can see what's going on. And here's another one that we did on the SPX. So we do a lot of trades. Every single week we trade the S&P 500. And then we also trade a more aggressive trade on a higher volatility position like a tech stock. So in this particular case, this is the commentary. The SPX has support at 30.69 and then down at 30.51. So let's sell below both. So in this case, we sold below 2 levels of horizontal support and uptrend support. And we took our position right here. So you can see it's kind of close. We had a little dip right here. We got filled at 95 cents, which is a really nice credit. It says let's enter orders to sell the Friday expiration 30/50 puts and buy the 35 puts for a net credit of 95 cents or better, good for the day. So we collected that credit. And you can see right here, it wasn't that far away, but the very next day, we got a gap up. It's following this trend. We got another nice big move higher. And then we had 2 days right here that were kind of downish. And I thought, the momentum is fading. The trend is starting to go sideways. I don't want people to all of a sudden decide to take their profits and have a big down spike and have our spread, even though it's way down here. I don't want that thing to get in trouble. So we sold the spread for 95. Right at this point here, I saw a couple down days and sent out an update. And I said, listen, let's buy back for 15. It was a 10-day trade. We'd only been in it for 4 days. So you don't have to hang out the whole 10 days. Sometimes these things are pretty quick. So we kept 84% of our profit and made some really good money on that. So let's see what happened the very next day. Boom. Once again, we get a huge gap lower and we would have been stopped out of our spread right here. And yeah, we got a rebound back up towards the trend, but we would have lost on that trade. And why would you want to stick around for, just an extra 15 cents? So the next day the market crashed. And so we sold a call spread. So we took even more money. And so we made a quick 25% gain on the reversal. So that just goes to show the value of once you've realized most of your money, there's really no reason to stick around, especially when the market's a little choppy like it has been. So the point is, once you've realized most of your profits, take them. And that is especially true in volatile markets. So the moment you close the spread, you eliminate risk, keep the profits, and free up your margin. So I'm just going to summarize this real quick. If you're taking notes, these are three good notes to take. So sell where the stock isn't likely to go. And number 2, and that's really easy to do with credit spreads. That's exactly what we're doing. We're selling all-time value. And you have an automatic 80% chance of winning just right out of the gate. So I'm going to put right up by this number 1, I'm going to put 80% chance. And that truly is how it plays out. And then the other 2 deck stackers actually increase your odds even more. So you sell short time frame, high volatility options to take advantage of volatility collapse. As we've seen, that's really important. You're taking in really big money. And when you exit, because of the volatility collapse, it doesn't cost you much to get out and you've realized the majority of your gains. So that's what we're doing. That's our object. And number 3, once you've realized most of your profits, exit the trade and lock in your gains. And at that point, you're home free, you're safe. Those are your profits to keep and you're ready for your next trade. And the other thing that does is it kind of increases the cycle. You turn your money a little bit faster. And this is already a pretty well-oiled money machine. At the most, you're going to stay in that thing 10 days. But a lot of the time, you can get out early. So follow all 3, and you stack the probabilities overwhelmingly on your side. You'll see this. If you trade credit spreads already, you know how valuable they are. But add these two deck stackers in there. I think you're really going to like it. So the big question that I get is, so if you follow this strategy, what can you expect to make? So the beauty of this strategy is consistent gains that compound quickly. Now, I know there's going to be a lot of strategies presented in this 2-day session that talk about these huge gains. What they don't talk about a lot with a lot of these strategies, because I've traded most of them, straight calls and puts, levered, trading breakouts, trying to really make some big profits, is they do work some of the time, but an awful lot of the time you get a reversal or something happens and you end up losing. So after trading, and I've been trading now, I've been trading options every day since 1996, traded stocks before then, seen a lot of different market conditions, seen a lot of different things happen with options. And what started happening is this, I started thinking, I've been concentrating so much on how much money I can make. What I should concentrate on is how much I can lose and what my likelihood of winning is. What are my probabilities? And that's why I finally landed on this. I've been trading it consistently. I've got trades in the market with my own money every single week, and have been, I finally switched over completely to trading credit spreads. Occasionally I'll buy some calls, but they're usually long-term. So I've been doing this since 2011. We've really got it down to a really well-oiled machine. And I like to let people know, if you follow this super dependable high odds strategy, what you can make, because a lot of people assume that if your odds of winning go up, your returns go down. Well, this is one of those cases where that's not the case, because there's a lot of premium, there's a lot of money available here with options. So we target 25% per trade. And what I want to talk about is what's realistic, what's possible. So, we hold back some of our cash for buybacks, rollouts, some really great strategies I'll teach you on how to make a trade that's going against you better. Occasionally you're going to have a loss, so you have to factor those in, money for buybacks, different things. So I want to lower that, and some people say, okay, 20%, 15%, maybe 10%, what's possible. So what I want to do for this example is I want to lower it all the way down to just 5%. Now that's on your entire account. And I think that's a little modest, and it's actually lower than what we've averaged over the years. But I want this to be really, really realistic. So it's an amount that I know anyone could make. And the key is you're turning your money actually every 10 days, actually a little quicker. You just saw a trade we were in it just 4 days and got out. But let's say that, to make it even better, or, a worse situation to know that you can do this, let's say you're turning your money every 2 weeks. So let's see what just a 5% return every 2 weeks looks like if you're starting with a $10,000 account. Now, keep in mind, we're targeting 25%, and we almost always get between 20 and 25. Sometimes we get more. So this graph is to show you what's possible. Now, we're all traders. We know that real life doesn't work out this way. You don't get these kind of uniform returns every 2 weeks. But what I want, the whole reason I'm showing you this graph is that I want to show you what even modest returns look like if you're making them consistently and regularly in short amounts of time over a long period. So if you're initially getting 25% and all you end up keeping after losses, buybacks, only using part of your account, all you can keep is 5% of that. 10,000 grows to 104,000 in just 2 years. And 104,000, a lot of people have that in their Roths. They've got that kind of money, so maybe that's not that impressive to you. But what I think is impressive is that brings in over $10,000 per month. And that's real cash flow that you can use. And you can, a lot of people are looking for ways to supplement their income, ways that they can trade from home, ways that they can beef up a retirement. This is the best way I've seen. And I've got traders all over the world that are doing this. We kind of formed a club. People stick with us a long time because when you're winning consistently, that's what you tend to do. So there's just one problem with this strategy. One of the good things is you can start with as little as $200 per trade, which is kind of nice. But there's just one problem. And that is, if you don't do well right off the bat, you might disregard the whole thing and quit. And that would be a shame, because this really is the best way to trade, because you're really high likelihood of winning, the hands-free nature of the trading, and the tremendous compounded returns over time. So if you like to get in there and really look at a lot of charts and get in quick and get out quick and look at a lot of complex, Fibonacci and all that. That's great. I don't want to take that away from you. If you kind of do that recreationally, that's great. But if you want something consistent, something that you don't have to worry about too much and you don't have to manage too much, because this time decay and volatility collapse really works with or without you. You don't have to watch it. It just, if you do the trade correctly in the beginning, it's just going to tend to go in your favor just automatically. And so if you want something in the background that you're doing with 80 or 90% of your money, and then the other 10%, you're just doing this really active trading, that's kind of a cool thing to do. That's what a lot of people do. So they know that the vast majority of their money is just making money for them very consistently. So that's what's cool about this strategy. And to make it really easy for you to do well, I put together a package where you can start off profitably and stay that way. And that's what really keeps you in the game. And it's an educational package that's the best anywhere for this strategy. I developed it about 15 years ago. And we used to sell it for $2,500. I'd go on live events internationally. I'd travel everywhere. I did this on cruise ships. And I still get emails from those people who are so delighted that they got it because they're still making money with it. And what I've done over the last several years is I've added a whole lot of content. I've added some really cool things, some like one-on-one education that you're going to love. And it's a fraction of what we used to charge. So just take a look. I'm just going to go over this real quick and show you what you're going to get. So it's called The Winning Secret. And it includes I start you off with a webinar on how to trade credit spreads for fun and profit. Shows you step by step how they work, why they work so well, and why they can work for you. So it's just a great introduction if you haven't traded them before. And then you get this whole package, 161-page downloadable ebook, 10-chapter video series. I just completed that. Super entertaining, fast-paced, shows you some really good illustrations. You're going to love it. It's kind of animated. It's really cool. And you also get archived webinars and video tutorials, so you can go over the information as many times as you want, and you'll get all new additions for life. So like I said, I just added the 10-chapter series, and we keep adding things. So for one initial price, you'll just get these upgrades for life, and you'll have lifetime access to the education. So that part's really cool. Plus, you'll get videos on how to set up automatic orders with our favorite broker for spread trading to trap profits, whether you have time to watch the markets or not. So this automatic trading is really cool. It's automatic orders. And if your stops hit, you're just out of the trade and you don't have to worry about it. You don't have to wring your hands and worry about being right there with your mouse at the perfect time. And they just really allow you to walk away from your computer so that you can do these on vacation. You can, make money while you're traveling. It's a lot more hands-free. The work or the effort is really setting up the trade in the first place, putting it out there. And then after that, it's pretty close to being autopilot. You want to keep an eye on it, but you don't have to watch it too close, and that's nice. So these automatic orders really allow you to do that. And this is what's really cool. So we also have a subscription that goes with this package. And this is something I've been doing for years. We have a lot of success with it. I've got people that have been with me forever. And you get 2 new high probability trades per week. You get one on the SPX, and you get one on usually, something that's moving a little bit more, something with a little more premium. And I'll show you exactly where to sell your spreads and exactly how to sell them for the possibility of maximum gains with minimum risk. Now, this is $97 a month, but I include it in your package for the first month. And then after that, we just expect the market to pay for it, so you don't have to. So one trade should pay for about a year of the service. So I think you're gonna really like being on there. And if something happens, if it's time to close the spread early, or you can get on our texting list. I text you on your phone, also send out an email, and I just let you know what to do. Most of the time it's hands off, but if a trade comes up that you need to know about, or there's an opportunity, I'll let you know. And as an extra bonus, I put together a 10-module video course specifically on trading the weeklies. Weeklies are the most exciting thing that's happened to options since they were invented. And they really started to introduce them in 2012, but then they made all these different stocks and indices with weekly options, and they're kind of a special animal. The time decay is that much more accelerated. You can really get on that perfect part of the time decay curve. So this is a really good course, and as a bonus, I'm going to throw that in. And this is what kind of separates us from everybody else, is our one-on-one attention. So the best way to learn is through one-on-one instruction, somebody walking you through it. So included in this package is a free one-on-one orientation to make sure you get your account set up the right way, get all the right clearances, you know how to take best advantage of the information. And, you know, I've got a great gal that does this. She's super, super cool. She spends some time with you and she, you know, shows you in some cases, you know, if you're not familiar how to put on a spread, she'll show you a lot of that kind of thing, how to navigate around and how to really get your account set up correctly, really how to do this. And this isn't some group webinar. This is just you and this fantastic gal I've got, and she's going to help you through this. And here's the big one. You also get a personal one-on-one money-making coaching session. And this is my top coach. Her name's Alicia. She graduated in the top of her class in finance, got a university here in this town. She is sharp as a tack. She's the one I run new options strategies by. We bat things you know, back and forth. And these are 45-minute sessions. Normally they're around $300. And most of the time people buy 3 or 8 session coaching packages. And the reason is she makes you money. So part of it is education, and part of it is you guys go looking for trades. She'll assess them for you. Obviously, she can't tell you what to buy or sell, but she can say, yeah, this is a setup that looks really, really good. I've done this in my own account. And we've got people that just do 8 session packages just back to back, one after another. And it's designed exactly where you're at. And I'm going to throw one of these in the package. So, you know, this is a $300 coaching session just all by itself. And these are really designed to make you money. A part of it's education, but part of it is looking at a live market and getting you trading right. So this, I think you're absolutely going to love. This will make you money. So this is all included. You get you get Alicia coaching. You're going to get your orientation here with Deanna. You're going to get you'll see me holding up a tablet with all of our live updates and telling you exactly what's going on and how to trade. Then you get this huge educational package. And it comes to, you know, we don't sell it for $2,500 anymore, but I think everything together comes to like $1,500 or something like that, $1,800. But for this presentation, for these sessions that we're having right now, we put together a really, really attractive package. And it's right here, and I can't even list everything that's in it. And the price is really, really attractive. It's anybody that wants to do this can afford it. That's how we priced it just for this. So to see the pricing, to see everything that you get, go to westmarktrading.com/Schultz, and that's SCHULTZ. You'll see the whole thing laid out there. You'll see everything that you get. You can get started. And we've got just a few minutes left. So Raleigh, I wanted to answer any questions. I know they pop up. I just didn't want people left not knowing, not getting a question answered or knowing how we do this or how
no problem at all, Peter. That sounds great. What a great presentation. And there are several questions that came up. So let me see if I can group these for you. One of the questions that came on a little bit earlier on in the presentation is, with just 10 days left, if the trade is going against you, it will almost be a total loss. Do you have any like bailout strategies on something like that, Peter?
Yeah, we don't want that to happen, and there's no reason for it to happen. So what we'll do with our automatic orders is we'll set automatic orders where if the stock really reverses against us, we're just going to close the spread and be out. And
sure.
I don't want to watch that. You don't want to watch that. So we just say, with Thinkorswim, and I actually produce videos that show you exactly how to do this. And the minute I get filled on our trade, we got filled on 2 new trades this morning at way more than what we were asking for because of the volatility. So volatility is a great time to sell these. But if they really go against us and they're going to threaten our position, once it hits a certain point, and I tell you that when we set up our trade, we're just automatically out. You don't have to worry about it. You can be at work, you can be driving somewhere, and it just happens with or without you. And it really limits our loss. In a worst case scenario, it cuts your loss in half. And then if we decide to set it at a breaker resistance or support, it's even better than that. So, you know, you'll make it all back on maybe 2 trades. Exactly. And you're winning over 80% of the time. So you have this mathematical expectation of winning.
Sure. And I think we all, as traders, we understand investors, we know that losses are part of the program. A couple other things that have come up here. Several people have asked about, can this be traded inside of a retirement account, an IRA? Number one. And number two, what kind of brokerage firms should people be working with if they want to trade this inside of an IRA or
Okay,
retirement?
so we do a breakdown of the brokers. There's been a lot of great options brokers that have come out in the last few years. We recommend Thinkorswim, and right on the site, you can go to thewinningsecret.com, and you don't have to pay anything. This is free information. I give a breakdown of the different brokers. I
Okay.
tell you why Thinkorswim is good. And the trick with Thinkorswim is when you open your account, like say you want to open a Roth there, if you don't answer the questions correctly, and if you don't fill out the form correctly, they won't let you do this strategy. But the good news is if you check a couple of the right boxes, they do let you do it. And it's a perfect strategy for a Roth. In fact, I have a whole webinar on why this is the perfect strategy to trade inside of a Roth account because of the cash-free buildup. So
Sure.
imagine if you were getting 5-10% returns every 2 weeks inside of a Roth and didn't have to pay taxes on it. So one of the points of the orientation, like if you're looking at the screen right now and you see this gal in yellow, Deanna,
Yes.
she's going to tell you how the proper way to open your account so that you do get the right clearances. That's why we have this orientation.
Okay.
So frustrating for people to want to do it and have the broker not let them. So she'll walk you through that. She'll tell you exactly how to set it up, check the boxes, fill out the form correctly so you can do it in a Roth.
Excellent, Peter. Let me look over here and see if we got some other questions that have come up. Oh yeah, interesting one. And once again, several people asked this question. Is there a best day in which to trade this kind of trade? Is this like a Monday trade that you make, or?
Well, Mondays can be pretty crazy and pretty wild because of weekend news risk. So I kind of like to let the market settle down a little bit so we have a sense of direction. So the update comes out really late on Tuesday. I'm pounding
Okay.
the keyboard there, burning the midnight oil. And if you're on the West Coast, you can get it that evening. But most people just click on it the next morning and see
Okay.
what our trades are and what they want to do. So that's Wednesday morning. The reason that I do that is it allows you to, go on a trip, extend, leave on a Friday or be gone on a Monday on a weekend trip or whatever, and not have to miss a trade. So I put it out in the middle of the week. We kind of have a pretty good idea trend and what's going on. And then we sell usually the expiration for the following Friday. So not
Okay.
that Friday, but the following Friday.
The one after that.
Yeah.
Okay, that sounds
Exactly.
great. Let's see here, some other stuff. A lot of compliments, Peter. Great job. Uh,
Thank you. I appreciate
Peter,
it. This is really fun. This is a fun way to trade because you win most of the time. And it's not because I'm great or anybody's a genius. It's just because the strategy, the probabilities are so stacked in your favor. And it's so funny when I first started trading, I thought I was going to win based on brains and wit and being quick. And that didn't turn out so well. I hate to say it. And so I started looking around going, man, we need a mathematical advantage here. And that's
Sure.
what this thing's all about.
And I think everybody, I sure hope everybody in the room appreciates that you're bringing, a lot of years of experience to the equation. It's one of the things that's special about these webinars, folks, is we get a chance to really spend some time that people have dedicated a good portion of their life towards being successful doing this. The last question that I see here is, and once again, Peter, several people asked this question, what's the minimum amount of money to get started? I think you said $200 or something like that.
Yeah, some people you can actually open an account at Thinkorswim with just $2,000, and you can
Okay.
just do one contract at a time, and you'll be fine. Most people start off with about 5,000, but if you don't have 5,000, that's okay.
Sure.
I think the biggest thing is to work up your confidence because we've all been kind of gotten excited about a presentation and started to do something, and oh my gosh, it didn't work out.
Right.
So I think once you make, 3-4 winning trades, you're going to go, oh my gosh, I can do this. And then you'll be comfortable adding a little bit more money, but you can start off small. That's no
Sure.
problem.
And I think that was
Most
the
people
point
do.
of that one slide that you had was don't quit. If you've
Exactly.
experienced a rough spot, just don't basically toss it in. Well, Peter, once again, man, fast hour. You covered an awful lot of ground. There's a time decay here
Right. Exactly.
that we're
Yeah,
dealing
that
with. So we've got to
acceleration.
sell you now. But thank you so much for your time, not only presenting today, but to put together this presentation. It was absolute delight having you with us. And Peter, I'm going to grab the slides, the screen back from you.
Okay,
once
thanks.
again.
Thanks for having me. You guys just do a fabulous job, and I just really appreciate it.